If we come in 2 negative quarters in a row, that's the definition, at least, of a recession. I have a sense that we're all, because it feels like one right now, and just awfully difficult time to be a long only trader.
Welcome back, everyone, to Be the Trader. Today is going to be a fun day. A lot of people are concerned about today's markets. Things are just not working like they used to. And so I wanted to bring an expert, someone who's been trading for quite some time, Michael Martin. He's been on the show before, so if you haven't listened to his interviews, he's been on twice, so definitely go check out those. But he's been a part of I believe it was the 80s, 2008, 9/11. He's been a part of multiple scenarios, different times. So I believe bringing him on the show is going to be able to give you guys just a sense of how you should be feeling, how you should be thinking, and how you might want to approach the markets today. And so, Michael, welcome back to the show, my friend.
Yeah, thank you, Alex. I appreciate you having me on. There's probably about 1 million people you could invite on, either for the first time or again. So I appreciate it. I get some really nice feedback too from your audience. So that means a lot to me because I'm a solo operator for the most part outside of what I do with Victor. So it's like when I hear nice comments via email or whatever, or someone shares what they put on YouTube as a comment. By the way, you should subscribe to his show and you should leave comments and interact and engage with Alex because he's a rock star.
I appreciate that, man. Well, let's get started, Mike. What for the people who are out there right now, and we're going to kind of pick different topics. The people who are out there in the long-term scale, and they're looking at their 401k, their IRA, and they're just like, man, I'm just losing, and I'm. Any suggestion to those people? Like some of them are like, should I get out right now? Should I buy more and just trying to find the bottom? I know you can't tell people what to do because we're not going to give people like, hey, you have to do this, but just your thoughts and your 2 cents on what you think about the market for long-term perspective.
Yeah. So for investors and 401ks, that's kind of like a dollar cost averaging strategy that's built in, right? Because they have a fixed salary and they're having payroll deductions or however it is. And so every month that money goes in. That's probably the best bet, just to stick with it. And if you have 20, 30 years, what do you care about what happens today? It's irrelevant. It's not part of your paradigm. You're building wealth, you're building a family, you're building a career, if you have that much time left. And so the good news is that the majority of your income earning years are before you. They're not behind you. So if you take a 40% smashing in the market any one particular year, it's not like it's irrelevant, but it's not germane to where you want to go. You'll survive. For the traders, that's a different ball of wax. It's a different question.
So for the traders, what would you say? Because they're the guys who are doing it every single day and they're just attacking the market.
Yeah. So that brings into, a few things, tactical and emotional. Like first thing I always do, some people know I've meditated, I've done yoga, this and that, but I always just try to keep a balance on stuff. And stay placated and not get too ahead of myself. That's why I like to start every day with a beer. Sparkling water. I like the idea, and this might not resonate with the day traders who subscribe to your show, but I like the idea of knowing what you're going to do, meaning what you're going to trade, the quantity, your entry prices the night before. I know it's popular in day trading circles to, wake up in the morning, scour the news, see what the hot topic is and this and that. That wouldn't work for my constitution. It's too manic. And even everything that we do on the future side is purely systematic with only a monthly reset at the top of the month. So on any given day, I'm not freaking out because something moves. The other thing you want to remember, until you have your system down, volatility does not equal opportunity. So you can't take that in and say, man, the thing moved, Target got crashed. I could have been short and I missed out on all that money. Well, how many other short sales have you done? You know what I mean? Like if that's not part of your trading ethos, and you're not, modeling yourself after, like, say, Julian Robertson or some of the Tiger, funds and Tiger Cubs, that too is not necessarily a missed opportunity because it wasn't what you were going to do anyway. And people have a way of internalizing this and then beating the crap out of themselves, which really digs them into a deeper hole because you get what you think about. And if you keep thinking about missed opportunities, we're going to have plenty of them. Friday, we had, and I always do this because I just like to see the data. What can I observe? On Friday's close, I looked at the 52-week highs and lows. There were only 30 stocks that made new 52-week highs. Of the thousands and thousands of stocks that trade, say, just in America, like New York Stock Exchange and NASDAQ listed, there were 30, that's 3 times 10, 30 names that made new 52-week highs. And I looked at the list, and off the top of my head, I think Exxon Mobil was at the bottom of the list. And that was pretty much the only one that I really recognized that I knew what they did. So the moral of the story is we're in a soft market and names are going to get punished. They're going to take it outside and get their asses beaten. And you got to remember, you have higher commodity and raw materials. Companies have to pay higher salaries to get people to, hire them and to get them to come back to the office. That's going to show up as higher expenses, which unless they're growing their revenue at the same rate, it's going to hit net income. So I wouldn't be surprised, because I've seen this before. Analysts are going to be like, man, I'm not going to be telling people to buy Walmart. The Walton family lost $160 billion of net worth. They probably had it to give. But the point being is, like, the market doesn't trust anything right now. And I think the analysts who are going to be looking at this saying, if the company's not going to guide us lower, we're going to beat them to the punch. Because I don't want to have a raging buy order or a buy recommendation on this particular stock when I know intuitively they're not going to meet their number given the economics. And that's before we talk about higher interest costs. Higher interest costs, it takes 12 to 18 months to cycle through, but sooner or later when companies refinance their debt, the new debt's going to better reflect the interest rate environment at that time. The tricky part is to figure out, like, if we get a bad, and I know you didn't, this is probably not what you asked, but we had minus 1.4 real GDP for Q1. Sometime in the second half of July, we'll get what the number is for the second quarter. If we come in 2 negative quarters in a row, that's the definition, at least, of a recession. I have a sense that we're all, because it feels like one right now, and just awfully difficult time to be a long only trader.
I want to take this time to say thank you to our sponsor, Cobra Trading. Cobra Trading is the go-to broker for day traders and short sellers. And I'm not the only one saying this. In fact, Benzinga awarded Cobra Trading as the go-to broker for short selling. They have a heavy focus on direct market access order routing, so you have the fastest execution. They have some of the best locate prices and availability. They also have amazing customer service. I've experienced many different brokers, and it's why I use them every single day and why I'm proud to have them as our sponsor. Sign up now by clicking the Be the Trader referral link below and earn 1 free month of software with Cobra and 25% off all commissions. Now let's get back to the show.
In that environment, when the fundamental overhang is really, let's just say it's dark. Most of the time, people don't like uncertainty, even when markets are good. Markets aren't good, and there's a higher level of uncertainty. And so, as I mentioned on one of my recent podcasts, there's 2 times in a trader's life when they want to learn to sit on their hands. One is if they buy something at 10, you set your protective stop at 8, your thing runs to 15, you adjust your stop higher, but you sit on your hands. You let your winners run. Don't be happy making 30, 40, 50%. Open your mind, because if you can't envision it, it's not going to happen. The other time that you want to sit on your hands are moments like these, because the market, again, if you're long only and you're not trading short or buying puts or doing equity pairs where you're like long the thoroughbred and short the horse that's going to the glue factory, you have to be hyper vigilant. This is not the type of market where you can trust. Then you have to figure out if you're, what's the best way to manage your risk. I advocate taking stuff home overnight, taking it over the weekend. So you could also trade smaller, trade a smaller bet size, readjust what your annual goals were. There's nothing wrong with that. If you try to say, well, my goal was to make 5 times my money, it's a good goal, but this is a tough market environment for long only traders to do that. And you get sucked in, right? More to the story. Guy traded his account up to 500K, 550. So 600's right there, but the million is right there too. So he's got two magnets that are dragging him to try to overtrade.
Yep.
Because there's that emotional win that you want of doing it. And if they've taken their account up 5-fold, there's a good chance they could take it up another 100%. But you have to do it. It's life on life's terms. And sitting around getting pissed at the market because the market's soft, take a week off. You're not going to miss anything. If you're 25, 30 years old, you take a week off. It's not logical for me for people to have that type of resentment that they have to take time off because the market's not amenable to your trading style. The best thing you can do is, again, learn to sit on your hands, because the more you try to force, it's like relationships. If she's just not into you, she's just not into you, and it sucks. But there's a million apps now where you can go find somebody else. Don't become, emotionally invested in the outcome of any one particular trade or any one month. The best you can do is follow your process. You're powerless over the results, right? It's a very sober way of looking at things. It's like a long-winded answer, but there's always moving parts. There's 8 facets to the diamond. So,
right. But you mentioned a couple of things in that, and one of them was, don't come at the market seeing missed opportunity if it's on a setup or strategy you constantly trade. Like when you wake up in the morning and target gaps down over 30%. And you're thinking, I should have got that. I'm missing opportunity.
How could I have missed it? I'm such an idiot.
Yeah, exactly. But you said that when you start thinking that way, you start to actually look for that. And in other words, like if you're missing opportunity, you feel like you're missing opportunity, you'll start to miss opportunity. And I think it's important you said that, because a lot of traders, they'll get frustrated with that, and then they'll try to force opportunities, right? Yep. To make up for something that they quote unquote missed, even though that was never part of their playbook. And I think that's very risky, and you can end up going down a slippery slope and just start revenge trading and losing a lot more, right?
I couldn't have said it better myself. There's so much wisdom in what you just said. It's how I've seen it happen. I don't want to sound like a cliche, but man, I've seen it happen so many times where person was doing pretty well, but they didn't have the fortitude or the grit to be able to do it consistently. So these types of markets are actually good for your trading career, because they build character. They don't care what you think. Bob Iger never gave a rat's ass if you own Disney. Warren Buffett doesn't care if you own Berkshire either. You have to find your own way. This morning I was reading the Wall Street Journal, and there was some famous manager all sitting with his custom-made suit and whatever saying, hey, you can't time the market. And I'm like, can we please put that dog down? Right? That's like old Yeller with rabies. Take the dog out, put a bullet in its head, and be done with it. Because we've been timing the market since Jesus was a kid. This is like all these fee-only 40-act guys saying you can't time the market. They're starving for assets. People are going to cash, and you can't earn a management fee on cash. So they're all getting hit. So you could look at the banks. When people start puking out their portfolios, the bank holding companies, whether it's Morgan Stanley or Goldman Sachs or Merrill Lynch or Bank of America, whatever the holding companies are, you can just see a cascading of things happening. And we haven't even gotten to the capitulation yet. So,
I'm curious on people who are thinking about the idea of everything's at a discount right now, right? Everything's at a discount, and they're like, hey, it's at a discount. I need to just start.
Don't start with me.
Up.
Don't even go there.
So
don't
please tell me,
there.
what should they be really thinking about? Because they're probably looking at, regular earnings per share. It's 16 times earnings per share. Now it's at a way bigger discount. because before it was like overvalued and now it's just dropping so much. And you can name any ticker right at this moment because every ticker is just going down to the shitter. So how, any words of wisdom just from your experience? And obviously everyone listening, like, it doesn't mean we know anything about what's going to happen, but it's good to have odds in your favor. So, what are you thinking to those people who are just trying to get the best deal?
Right. But so I don't know that it's a guesstimate because we can observe that data. We can observe that behavior, right? It goes back to the black swan. Just because you haven't seen it doesn't mean that it doesn't exist. So when you look at the price earnings multiple, to me, that's a horrible gauge of way of managing prices and price targets or what have you, because most of these names, at least coming into today, were trading on expected future earnings. So even though they've gotten, smashed recently, it doesn't mean they can't go lower. Cheap becomes cheaper. And so people think about it. The way I describe it is this: if you looked at, the y-axis on your chart, the bottom is the domain is the dates, right? It's a 6-month date. If you have a 6-month chart, and there's the price charts. And if you were looking at something like Tesla, for example, which has been, in recent years, high as what, 1,200, and as a low as like 540.
Yep.
So you can say 540 is a better entry point than 1,000. Because all those prices are relative to one another. And if I could call up a chart, I would do it. But you're more concerned with position size first and foremostly, and then where does the breakout occur after the change in trend, up to the point of, say, the reversal, right? And so a recent move was like, what, 700 to 900, depending on where you put your exit on your profits. You could have taken $150 out of the trade, but you can't say that 700 was a better price because all the numbers on the y-axis are really just relative to one another. Cheaper doesn't mean better, is what I'm trying to say. So the best thing anyone could do in this type of an environment is wait for the downtrends to end. Right? Downtrends, you draw the line on the tops, you connect the tops. There's no reason to connect the bottoms. Channels, look at me. Channels are worthless. They're worthless. I see people pumping charts through Twitter or stock twits, and I'm like, man, all it tells me is that this person doesn't know their ass from a hole in the ground.
Why do you say that? Channels are worthless.
Well, what's the point of the lower boundary? Is that a price target or something, or it has to stay within those boundaries?
Some would say that it's could be an entry zone. Some would say it could be a short price target. I'm just taking devil's advocate here.
Okay.
And at the end of the day, like, I'm just curious.
So here, I'll be humble and say, show me the data then, but don't just draw the line for the sake of drawing it, right? 2, when you short sell is very different from buying breakouts. And a good short entry is when it rallies up to the trend line and then reverses back down. That's a whole different trade than trying to sell the breakdown at our 20-day low. So short selling to me and buying longs are 2 different deals. When you buy
referring to buying longs as channels is not a good thing?
No, because again, to me, it puts a mental limitation on where the person thinks it can go. Like, what is the line supposed to signify? To me, I called them in my book emotional band-aids. Like, what uncertainty do you think it's going to eliminate for you? Nothing. It doesn't change the character of the stock. Because when an analyst comes down and says, oh yeah, XYZ company was looking at printing 19 cents a share, but the way we look at raw materials and commodity expenses, and oh, by the way, diesel fuel or bunker fuel, because the stuff has to be shipped, and or, Sony and what's the other one? Nintendo are going to be shy on their units for sale because they can't get the component parts. Fundamentals matter. For all the charts that you're sitting at, you have to put your ear to the track and know what the hell's going on. And things are tough right now. Wait for the trends to end, like the downtrend, and let it consolidate, and then look for that next breakout to the upside. But don't, everyone says, hey man, don't catch falling knives, but they're doing it. They're like, oh man, the stock was here, now it's here. It's so much cheaper. I can get it at 45% off. Great. But if you wait another couple of months, you'll be able to get 75% off. There's no such thing as a baker's dozen here. Doesn't work that way.
I'm glad that you said wait for the downtrend to break and then consolidate. Because
Has to consolidate.
Because what happened in 2020 when the market kind of just cracked, it just kind of rebound pretty quickly.
Mm-hmm.
And look what's happening. Like it rebound really quickly. And usually, I'm a day trader. I trade off of 5-10 minute charts on the intraday. And if something just spikes very quickly, I expect it to retrace very quickly.
Yeah.
And that's kind of, I felt like in 2020, and I'm sure others felt this way, I was trying to be patient and wait for it to consolidate after breaking the downtrend, then show me some reversal signs that I was going to buy in. But I missed it because it just went all the way up, in my opinion. So I ended up missing it. And so now that same person, including me, you're watching it go down. I like that you said wait for it to consolidate because it could easily just rally really quickly and then easily continue to fade. Because a lot of people are just going to draw a downtrend line and just easily buy. As soon as that line breaks, they're going to be like, all right, I'm all in. I'm all in. And that could be, a recipe for disaster, or constantly cutting over and over, trying to get back in, cut, get back in, cut, get back in, cut.
So for everybody listening that was struggling with that, what Alex is speaking about is what some people call a V bottom. It goes down and then it jettisons back up. I have 33 years of experience, and I will look everyone in the eye, figuratively speaking, and say this: I suck at trading V bottoms. I can't do it. I've never been able to do it. If you can, my hat's off to you. So I wouldn't beat yourself up, Alex, for missing that type of trade, because it's insanely hard. It's one of the harder patterns, if you're a pattern watcher, to trade. But I do like the idea of something coming down and then maybe for 2 months consolidating, because my ethos at that point is like, there's only one class of Apple shares that you could trade, for example, and everybody's watching it.
Yep.
And everyone has a chance to puke out their position or to nibble long. And so you don't want to buy into the range either of the consolidation, because that's just like dating. It's indecision. You crushing on somebody, but they're just not showing you any love, right? So there's all this kind of sideways action, which to me is indecision in the marketplace. You could still break out to the downside, right? And I think we saw that in crude. In crude, it broke out to the upside. It was uptrend, it consolidated, then it broke up again. So you can have those kind of continuation patterns. I want to say this though. I don't have any use for the popular ones, the pennants and the flags and all that kind of stuff. Okay. I don't pay attention. I have my own because I look at the data. But my advice is, for this type of a market, if you have your wish list, you have to remember this. Put 20 names on your wish list, write the tickers.
Yep.
But then at that point, and this is an important point, your job is then to disqualify as many of them as you possibly can. And that's going to be emotionally hard for the newer folks, because they think all this stuff means opportunity. So, it's like having 20 prospects in your lead box. I would much rather have 19 no's and 1 yes than 20 maybes, because I don't know what to do with a maybe. So put your list together, even if you're doing it the morning of, but your goal is to not think of it like, how is I can make all this money and what the opportunity. If you want to be and get professional results, you have to do professional behavior. And the pros are excellent at keeping their losses small and not putting good money after bad. If you look at anyone that you might look up to, Paul Tudor Jones, the guy from Duquesne, any of those guys, Druckenmiller, they've taken their losses, but they never put themselves out of business, right? So focus on playing defense. You can take your chances. You can take a flyer, but only risk 1/4 of your portfolio, 1/4 of 1% of your portfolio. And then do it 50 times, because one data point isn't going to mean anything, right? You can make a bad decision and make a lot of money. And the worst thing you could do at that point is say, man, I'm onto something. Right?
Yeah.
So you can't look at the result of a decision and then reverse engineer it and be like, my decision-making process is sound.
Which so many people do. They think because they nailed something.
Made money. Dude,
right.
I nailed it. Dude, I nailed it.
And
then they show you the chart, then they put their P&L on whatever, and they're like.
Then they post on Twitter. Yeah. Like,
look at me.
What I love you said, before we start to wrap this up, you said something that was really, I think everyone needs to rewind and re-listen to what Michael just said. And that was the whole idea of have 20 names, but then disqualify. Like, make yourself find reasons why it is not a good opportunity. Because if you look for why these are all good, you're going to find everything and anything to get in. Like, you're going to buy every one of those. But if you try to disqualify them, then you have higher odds chance that you pick the right ones. And you might miss some really good ones, right? Because you're disqualifying them. It doesn't mean you're going to disqualify all the bad ones. You might disqualify one that just rips. And that's going to happen, right? That's just part of trading.
A certain amount of randomness is going to definitely happen. What I'm thinking, though, of is like if you are a chart pattern trader and you're looking at something and it's not quite there, it goes. The minute you start letting people off the hook, you start letting yourself off the hook. And so that's an equation for disaster. You have to think of it like the scientific process. I have a thesis. I have a bunch of data. I go into a lab. I draw some conclusions. Then what do they do in the scientific community? They publish the paper.
Yep.
Then everybody in the world can come in and say, well, yeah, but you missed this, or here's the results that we have. And it moves the conversation forward. But it becomes, I guess, pluralistic. So if you're a solo shooter, and I don't mean joining a chat room, please, for the love of Christ, don't join chat rooms and don't ask anyone else's opinion on the desk. That doesn't help you. You can only learn to trade by doing it yourself. Other people's opinions do not matter. And that goes against the grain because there are people that I know that sell subscription services and all that. And that's interesting. Maybe that saves you time from having to do the quantitative work yourself. But ultimately, it's an individual's responsibility for their P&L. If you make money, it's your responsibility. It's your fault, so to speak. If you lose money, it's also your fault. So you have to play devil's advocate and say, okay, how can this kill me? It's not how much money you can make. If that's how you're coming to the market, you're doing it all wrong. You have your list and you're like, okay, where can I get hurt? Where's my blind spot? And that's all I do professionally is look at the model and say, okay, how can we tweak this? How can we improve it? Where is, because it's 100% systematic. Where can we get hit? Where are the blind spots?
100%. And look, Mike, I know people are probably like, Alex, why are you entering this now? I want to know more. And I want everyone to know right now, you have to check out Michael's podcast because he talks about all of this. And every single day, Monday through Friday, he releases an episode and it's quick to the point. I personally listen to it myself.
Thank you.
Often, which I really love, which is why I wanted to bring you back on the show because I'm like, man, he's always talking about what's happening right now, how you should be feeling. And that's why I wanted my listeners to hear your thoughts on my show and maybe go check you out as well. So, Mike, could you tell everyone how to find that show? And I think you give away a free book as well.
So the precursor to why do I do it if I'm so busy and so successful? And the answer is that when I started, I couldn't get anyone to help me. There was what we called intellectual greed, and I couldn't get into the club. I couldn't meet the desk managers at what was, like David Shaw or Bear Stearns at the time had really good prop trading, or Jay Aaron at Goldman Sachs. And no one would help me, like just for the sake of doing it.
Yeah.
Like as a good gesture. And I remember saying, man, if I have one little speck of sand on the beach of success, I'm going to think and grow rich, man. I'm going to put it out there and give away what I want. And not have bitterness, right? I got hurt with Revco collapse and I could turn really, really bitter. So my goal is to do something bold and brief. Each day it's 5 to 10 minutes. It's more of a Stephen Covey thing. It's trader psychology and emotional intelligence. There's no tradable or actionable ideas. Once in a while, I say, man, I see the market's heavily long here in a weak market, and I think they're going to get hurt. We'll have to see how things unfold. But yeah, so it's called The Michael Martin Show. It's free. You can find it on like Spotify and Stitcher and Google Podcasts, Apple Podcasts. If you have an Alexa, you could ask because we're on Audible. And then if you don't want to subscribe for whatever reason, because I do publish stuff through the podcast Libsyn that makes it to subscribers that I don't embed on the website, and that's to incent people to subscribe. Why do I want that? Well, because I get the data. I can't tell from web hits. It's really hard to conclude, but I do have the episodes embedded on the site. And while you're there at Martin Chronicle, I wrote a book in 2011 for FT Press called The Inner Voice of Trading, forward by Ed Sekotas. I got interviewed a lot of great guys. Michael Marcus, Bill Dunn, there you go.
Great book. You guys got to check it out.
Thank you so much.
Definitely have to check it out. I love this book. And I asked you to send me one because I read it and I was like, man, I need a physical copy. So thank you so much.
Right. Now, there were trades during that period of time where I completely smashed it. I caught sugar from 8 to 19 on the March of '06 contract. But it doesn't help people to show everybody your trophy deer heads on the wall, right? We only going to connect by how we manage risk, how we feel about losing money to me. So I learned mostly from how I lost money. The podcast illustrates, I guarantee you, I haven't looked at the numbers, but say there's 250 episodes the year, probably 200 of them come from experiences that I had where I had made mistakes or boneheaded decisions, and I'm trying to kind of pay it forward so that everybody who listens can accelerate their learning curve. I don't know if they will because they have to do the work, but at least I'm putting it out there. And I try to be bold and to be brief. If I can't say it in 5 minutes, I can't say it. But you can get the free, the audiobook version of Inner Voice Trading for free. I could have made millions selling it, but it's not my emotional makeup. I'm a Christian and it means a lot to me. I don't talk about it a lot because people hate talking about all that kind of crap in politics, but I'm not some bumper sticker Catholic going to church on Easter and Christmas. Self a good guy. So I give that away. Hopefully people can learn from it. And if nothing else, they can follow up. It's basically it's a more of a memoir. There's no tradable ideas. There's delineation of things that I looked at that I thought were right, where I lost.
Well, I definitely want to mention though, it's for anyone who has been trading and has somewhat of a setup or has been working on something on their own. I think it's huge because it really helps you because it's the entire trading journey is you versus you constantly.
100%.
And I think you hit that on every single episode in different ways of different experiences. And I feel like I'm literally talking to you and listen, like whenever you're talking on your episode, I literally feel like I'm like in front of you and I'm like, oh yeah, okay, let me write my notes down. Right. So it's really good. So everyone, you guys need to check it out. Again, Mike, I can't say it enough, man. Thank you so much for being on the show today. Thank you so much for giving your insight on what you've experienced in the past. Again, everyone, check them out. And again, thanks, my man.
Yeah, and you're welcome. If you have any suggestions or constructive criticism as to how I can make the show better, I'm just it's a one-person guy. I'm sitting here. Hi, everybody. It's Michael Martin. Happy Tuesday. Thanks for being here. It's right here, so, and I do it largely off the top of my head. But I'm happy to take suggestions. The listeners oftentimes send in emails for suggesting topics. So I'm open in that regard too. I'm always trying to move it forward, but thank you so much for having me on. It's always a very humbling experience to contribute back to the community. That means a lot to me. These are our people, Alex, right? And it's in
100%.
Everyone's vested interest if we help them succeed. Because then I think the universe is going to groundswell beneath us and behind us and push us forward. And you're doing God's work by all the interviews. And look how much your show's grown. Look at the subscribers. I mean, since we met, I think you're up fourfold.
Thanks, man. I appreciate it.
That ain't random. It's not random. You don't grow that fast unless you're doing quality stuff and having good guests. So yeah, thank you for being a good host and having me on again. I appreciate it. I hope I can anything that I said can help some of these folks, get better faster.
Absolutely. I have no doubt. Take care, Mike.
Hey, buddy.